Hi everybody, welcome back to episode 9. Are we in a recession, or are we gonna have a recession? Who knows, let's find out. But before we get into that, let's do a quick recap. Inflation for the year ending February, that's a year-over-year number, came in at 2.8%, which was lower than the expected 2.9%, which is great. With the largest contribution to the increases attributed to shelter. So we gotta get that shelter or that rent price down, which increased by 0.3%, but largely offset by a 4% decline in airline fares and a 1% decline in energy. This still represents a 0.8% adjustment above the Fed's 2% target. Next, tariffs. We did have a few tariffs that went into effect on March 4th. So President Trump has been causing a lot of commotion with these tariffs. The Customs and Border Protection, CBP, reported an additional 25% tariffs on goods that do not satisfy U.S.-Mexico-Canada agreement. We also had in effect a lower additional 10% tariff on energy products from Canada that fall outside of the USMCA preference, a lower additional 10% tariff on potash imported from Mexico and Canada that falls outside of the USMCA preference, and an additional 20% on goods from China. Hong Kong increased by 10% on March. Earlier this week, we also had the House of Representatives voting on the budget approval. A government shutdown does look like it's most likely. House Democrats are labeling the funding bill proposed by the Trump administration as anti-working class, anti-support for veterans, and disconnected with American values. The bill is essentially a 99-page funding bill, which seems on the lower end in terms of pages. These things are usually super long. But it reduces the budget deficit year over year. So compared to the year 2024, it would be lower in the year 2025. It does, however, increase the military budget by $6 billion, with an additional $6 billion for veterans, healthcare support. So that makes sense. It's a Republican administration after all. However, non-defense spending will be $13 billion lower than the recent government funding bill. The proposed legislation reduces funding for disasters, but it increases funding for the immigration and customs enforcement deportation operations. It also increases funding for the WIC, which is support for women in lower income families, and this increases $500 million. The bill was passed in the House earlier this week, 217 to 213, with a big surprise being that one of the Democrats defected and voted for the bill, and then also, surprisingly, a Republican defected and voted against it. So now to get into the video, whether or not we might be heading into a recession, or if we're already in a recession. Kathy Woods has been recorded stating that she believes that we've been in a rolling recession. Well, it's not insane that economists have been saying that there is an impending recession looming behind every corner. The pandemic did create a ton of disruption, which led to widespread lockdowns and was all in all very disruptive to the real economy. That did cause a flash recession, but since then, because economists don't believe in flash recessions, obviously, I guess the stimulus pushed us out of that recession and created a ton of demand because everyone was locked at home and just wanted to use the money that they were getting to buy stuff. Retail therapy. And because of that, we had a supply shock which pushed inflation higher. So based on an article from JP Morgan in 2023, this rising inflation was met with a very strong, they call hawkish Fed. So to combat the rising inflation, the Fed aggressively started raising rates, and they were committed to this tightening cycle to reduce excess liquidity in the economy, to smother that inflation. And so the census at the time was that we would this higher inflation, plus at the time while we were rapidly opening up and getting more jobs, they were afraid that it would lead to a recession. It did not. We had a great growth period. In 2024, economists forecasted a recession due to the SAM rule, which is an indicator that basically says, because we had a small rapid jump in inflation, in unemployment in 2024, that the SAM rule is basically, if you get that rapid bump in inflation, then in unemployment, then you're most likely gonna get more unemployment as a result of that. So continuous increasing unemployment numbers. They thought that this would lead to or trigger a recession. It did not. Now we're in 2025 with everything I outlined in our recap. Trump 2.0, his first 3 months in office with his administration. Again, fears are starting to build up that we might have a recession right around the corner again. But I don't know if I trust it. If you look at the chart right now that we have up, real GDP has been destroying economists' recession expectations pretty badly. So a lot of people look at the market as an indicator of how well the economy is doing. This isn't a horrible thing to do, but people fail to realize that in the short term, our markets are a gambling machine. But in the long term, our markets are a weighing machine. A considerable amount of daily movement in the individual stocks, as well as the overall indexes, are strongly swayed by sentiment. Not to mention that we do have a lot of algorithmic trading that trades based on headlines and different things that's happening, natural disasters, etc. So sentiment creates these short-term swings, but over the long term, as everyone knows, the market returns over a 10-year period about 10%. This does not mean to say that I do not believe that some of the current administration's rhetoric and policies may not contribute to slowing of the real economy. But relative to the likelihood of a recession this year, I think it's overblown. Honestly, it would depend on data. I'm very data dependent, and there's very few data indicators that are pointing to a recession. If you look at the chart we have up right now, it's the yield curve. It's the probability of a recession, a 12-month period using US Treasury yield. And if you look at the chart, every time the curve has inverted, we've had a recession. 91, 2000, 2008, and then 2020. It looks like it inverted again in 24. We should have had a recession, or we should be having a recession quite soon. But it's not good to just look at one indicator to identify whether or not something as broad-based as a recession is possible. So it's always good to look at other indicators, and I've outlaid a few other charts, and I'm going to discuss them. For example, if we look at the threat of private sector debt, right? Whether or not the private sector will be able to service their debt. If you look at it as a ratio, as presented in the graph that we have up right now, very unlikely that private sector debt will be an issue, or an indicator of a recession. It isn't. If you looked at all the other instances where a recession was triggered as a result of, partially, I guess, or as an indicator of a recession, debt was not. It was much higher, considerably higher, with the exception of 2020. Obviously, it was a recession that caused that. If you look at momentum is a very good and very important indicator when considering a country's GDP, gross domestic production. Factoring in slowdowns or diversions to growth, that may indicate a likelihood of an economy turning, but JP Morgan states that they don't believe that an economy losing steam is a standalone representation or indicator for the possibility of a recession. But just the same, momentum seems to be moving in the right direction. If you look at the chart we have up right now, at least where the US in all is concerned. Like overall, the US has very strong demand. State by state it may vary, but if you look on the chart on the left, very, very low likelihood of us going into a recession right now. If you look at it, most of the chart dips below zero, in demand dips below zero in the scenario of a recession, and we are nowhere close to zero, and the trend doesn't seem to point that we're heading towards zero. And if you look on the right, there is a bit of weakness if you're looking state by state, but again, I don't believe that that's enough to say that we're heading into a broad-based recession. Profits is also a very good indicator. Declining corporate profits tend to be a forward-looking indicator as to whether or not recessions may be likely in the near future. Also, the strength of the household's balance sheet, like you and I, whether or not we're in a comfortable position, our debt-to-income ratio, that plays a major role when forecasting for a recession. But as you can see in the chart we have up right now, both profit margins for corporations and household balance sheets remain relatively strong compared to previous years, even though household balance sheets have tapered off since the big bump during the COVID recession. Due to the stimulus, a lot of people had a lot more disposable income, but it's still relatively strong. Doesn't seem to be pointing towards any risk of a recession. Markets also, they're the last chart I'll be putting up right now, but definitely not the least, because a lot of people base their outlook of the economy on what's happening with markets. So markets are not really pricing in risk of a recession. Investors are still willing to pay generous multiples for companies positioned to perform well, regardless of some of the current administration's rhetoric that might seem counterproductive to with their economic and trade policies. But people and investors are still quite confident. Now, markets can be very noisy, but usually, as you can see from the chart, they're very good at determining the likelihood of a recession or periods of two consecutive quarters of negative GDP growth. And it doesn't look like that's the case at the moment. So the only indicator right now that's strongly suggesting that we might have a recession would be the inverted yield curve, which it does send false signals. It has been known to send false signals. Also, the demand in states, in some individual states, seem to be a little weaker, but overall, U.S. demand seems very strong. So in conclusion, my opinion is that fears of a recession this year are overstated and possibly being used as a weapon for political and economic leverage. Now, I don't want to talk too much about politics, but it's kind of woven into this current administration. because of the way that they're going about their economic reforms, both domestically and internationally. I think it's definitely possible that the rhetoric or chatter around recession fears, it's basically to create uncertainty and doubt within the public, both investors and consumers, and especially in people who voted for the current administration. A bit of buyer's remorse might be settling in. Tactics to weaken This could be used as a tactic to weaken the current administration's ability to make more changes, especially since the changes have been difficult. These have been unpopular changes that may even add to inflation. Rather than make things more affordable for Americans, it might make things more expensive in the short term. And because of that, it'll have trickling effects, especially on the political side, for the current administration, especially in about 18 months when we'll have the midterm. So a seed is being planted that this administration is less friendly to the stock market compared to the previous Trump 1.0 administration that was extremely dependent on the performance of the stock market. This is detrimental to anyone the older population, especially people who are retired, and their largest investments are in their 401ks and pension funds, which given the current sentiment, if it continues, can have detrimental effects on how they navigate the next 4 years of their retirement. But then on the other hand, being devil's advocate, could it be possible the current administration also wants this uncertainty and negativity? Sentiments to prevail, at least in the short term, to force the Federal Reserve to move policy by cutting rates earlier than they would have liked, since most of the indicators that would signal higher or rising inflation are being significantly affected by domestic economic policies and international economic policies. So while in some cases these policies could be seen as inflationary, people might choose to not spend their money right now and maybe hoard cash, maybe move investments out of the market because there's such a large it's so much uncertainty out right now with tariffs and no tariffs and 200% tariffs and 25% tariffs. This is a period where waters are not calm, very tumultuous. But either way, it is still my position that we are unlikely to see 2 consecutive quarters of negative GDP growth in calendar year 2025. That being said, one of my favorite quotes from Mark Twain is that history doesn't repeat itself, but it does rhyme. So personally, I think if we were to experience a recession this year, it would have to be something of a black swan event. Something that no one could have anticipated or predicted, just out of nowhere. I mean, one scenario I could see happening, which I think is unlikely but possible, is World War III, with Europe ramping up anti-Russian sentiment and possible continued support for Ukraine, and possibly bolstering Ukraine in the war to take on Russia. These things can escalate very quickly, and it seems like they are being escalated. So that's a huge risk in the market right now. But aside from that happening, which I think that these countries are not prepared for that level of commitment that a global war would consume every single resource that they have. This would not be a very good outcome for anyone. So I would hope that the global leaders are not readying up for any type of serious war with Russia, and we can come to peaceful resolutions. But aside from that, you know, I don't think it's happening. But if you disagree with me, I would love for you to send me a comment on the video. You know, please like and subscribe. It would help a lot to let me know whether or not anyone's watching this. I do see sometimes the views are relatively healthy compared to the amount of subscribers that I have, but I would love to see more subscribers, and I would appreciate some dialogue. If you disagree with me, I love people that disagree with me. If you disagree with me, please put it in the comments. I have all the comments open. You hate my glasses, you think my face is stupid, whatever it is, please respond in the comments, or like and subscribe and share the video. And I look forward to having more chats with you in the future, and thank you for tuning in to Casual Folks.